Hey, I'm Clark Holt with Elevate Wealth Advisory. On this week's edition of WealthWise, we're looking at dimensions of expected returns, what it is and why it's important to you. Rather than view the market universe in terms of individual stocks and bonds, it's important to look at dimensions of expected returns so that we can identify areas that might give us better performance. This approach relies on academic research and internal testing to identify these dimensions. This helps us get to the areas that offer higher expected returns over time. This is very important when building globally diversified portfolios. Research shows that some market areas have higher expected returns than others. For example, in the stock market, dimensions are size, like small cap versus large cap, relative price, like value versus growth, or profitability, high or low. In the bond market, these dimensions are credit quality and term, or the length of the bond. The return differences between stocks and bonds can be considerable. So can the return differences among groups of stocks or bonds? To be considered a dimension, it must be pervasive and persistent across all markets. So if there are systematic differences in expected returns and research can identify them, how can the insight be applied to practical investing? We select globally diversified portfolios that are broadly diversified, looking at areas that offer higher expected returns. These strategies can emphasize securities with higher returns by overweighting them compared to their market cap weight. One way to visualize overweighting is to think about an ice cube tray with sections that are shallower or deeper. In a portfolio, each section holds many stocks that compose a market area, and those with greater return potential are overweighted, just like larger ice cubes. In a dimensions-based approach, capturing returns does not involve predicting which stocks or bonds or market areas are going to outperform. Forecasting this is impossible. Rather, the goal is to hold a well-diversified portfolio that emphasizes these dimensions of higher expected returns. Focusing on these dimensions helps investors have a better investment experience. It starts with an advisor creating an investment plan based on market principles, informed by financial science, and it's tailored to a client's specific needs and goals. Having a structured portfolio that's globally diversified gives us the confidence and the encouragement to stay with a plan and stay disciplined through various market conditions. Focusing on dimensions of expected returns is very important. We hope you enjoyed this week's WealthWise. We'll see you next time.